everyone. My name is Adam Remis, CPA. I've been a CPA for nearly 27 years, and I absolutely love helping my clients save money on income taxes. But first, what I'd like to do is talk about a couple of very specific acts that have affected and changed the world of tax planning. The first is Secure Act 2.0. It was actually signed into law in 2022, the very end of 2022. And it changed so much when it came in to tax planning and income taxes for businesses. It changed what we do from a retirement plan perspective, what we do from a income tax perspective for businesses, and more importantly, what we look at over the next 3 to 4 years for our clients, because the impact was absolutely massive. The second item is what they call TCJA. It's the Tax Cuts and Jobs Act. That actually occurred about 4 or 5 years ago, but once again, it had a significant impact into retirement planning, as well as what businesses can do and should do off their different types of organizations, whether they're an S Corp, C Corp, partnership, or even just a Schedule C sole proprietorship. Last time we spoke heavily into what type of organizations you should have. Remember, we like to have an S Corp, a C Corp, a partnership, and a Schedule C all in the environment. Today, we're going to heavily dissect deductions, tax credits, and down the road, when you want to sell your business and or acquire a new business, what you should think about. So those are the 3 main items that we're going to talk about. Tax credits is another area that I'd like to discuss. Tax credits reduce tax liabilities 1 for 1. It's dollar for dollar. But I wanted to kind of explain the tax credits for TCJA and the Secure Act changed the landscape because it eliminated a lot of tax credits, but it included some other tax credits from a business standpoint. The first tax credit I'd like to discuss is research credit. Research credit gives businesses an incentive to increase their investments in research. Certain startups, in general, these are revenues, businesses that have revenues less than $5 million of gross receipts, can take the credit against their payroll taxes. The credit is complicated to compute, but the tax savings are enormous. And once again, because it's a tax credit, it's a 1-to-1 relationship to decrease the amount of taxes you ultimately pay. Another tax credit is Workers' Opportunity Credit. This has been around, WOTC they call it. This has been around forever and ever and ever. But unfortunately, not everybody takes advantage of it. The credit is designed to encourage hiring from various disadvantaged groups, such as certain veterans, ex-felons, long-term unemployed, and supplemental nutritional assistance program benefit providers and receipts and recipients rather. It's called the SNAP program recipients. The maximum credit is generally $2,400 per hire, but in some cases it can go all the way up to $9,600 for certain veterans. We in our organization love to hire veterans, not only for this tax credit, but also that group of folks are unbelievable workers for us, and they've benefited and we've benefited from hiring. One of the stipulations for the WOTC credit is unless the Congress makes a move and changes things, it's going to expire in December 31st, 2025. Another credit that came in from TCJA is the New Markets Credit. This gives investors who make qualified equity investments in certain low-income communities a 39% credit over a 7-year period. There's a lot of complications in order to qualify for this credit, but believe me, credits are once again dollar for dollar decreasing your tax liability from a federal perspective, and this is enormous for some of our clients. Once again, this credit is scheduled to expire December 31st, 2025. The family and medical leave credit is another credit that came into play for TCJA. The TCJA created a tax credit for qualifying employers that begin providing paid family and medical leave to their employees. The credit is equal to a minimum of 12.5% of the employer's wages paid through the leave and up to 12 weeks per year, and can be as much as 25% of the wages paid. Once again, like all the other credits, this credit is scheduled to sunset December 31st, 2025. The next section I'd like to talk about to end our presentation is the business sale or acquisition. When you sell your business, you really need the advice of a CPA. I know you're going to have your attorney, and they're the ones who are going to draft things up, but the CPA becomes integral into that process. There's two different types of business sale. One is an asset sale, and one is a stock sale. Stock sales normally are used when a license, like a tobacco license or a liquor license, is being transferred with the business. That has certain specific types of tax implications compared to an asset sale. Whether it's me or whether it's your CPA, before you even think about selling your business, please work with a CPA, because it's absolutely imperative to understand which one is going to be best for your tax situation. But here's some very specific key considerations. With a corporation, when you're trying to sell your business, sellers typically prefer a stock sale. Why? Well, it's capital gains. You get to treat your most of your income from the sale of the business as capital gains. Why do CPAs like that? Well, the max you can pay on capital gains from a tax perspective is 21%, versus income tax being well over 45%. Huge difference. If you are from a buyer perspective, buyers will generally want to maximize their further depreciation write-offs. So they're going to want to buy it from an asset point of view. You can see the tag, the pulling and the tagging going back and forth here, because very quickly you have opposite requirements from the seller and from the buyer. This all needs to be worked out and negotiated, but understanding the tax implications to your decisions is absolutely critical. Typical sales, transfer of ownership and other things. If you have a business and you know who the owner is going to be, in the sense that you've worked with them and it's a private sale, one of the things to think about is to sell that business over in a long time frame. Don't take all the business proceeds year one. Take the proceeds over a number of years, because if you can do what they call an installment agreement, then you're stretching out the business income and the business taxes. The rule of thumb from our perspective is very simple. Always defer income as much as possible and take all deductions as much as possible in the current year. I hope this has helped to talk about business income and expenses and deductions from a tax planning perspective. My name is Adam Remis, CPA, and I look forward to seeing you next time. Thank you.